So today we're going to be talking about the difference between going long and going short. So hey everyone, I'm lead trainer with Stocks Trade, Tim Bohen. So there's two real directions to trade, obviously. What we're going to look to do is trade stocks that are going up, and we make money when we buy low and sell high. Now, might sound very simple, but a lot of people misunderstand some of kind of the intricacies, and that's what we're going to go over today. And then also, when we talk about going short, a lot of people think, oh, okay, short-term trading, like day trading or scalping. And yes, there is such a thing as short-term trading, which is most of what we do when we're talking about day trading or swing trading. Even in the real world, as we say, swing trading is still considered a short-term strategy because it's over days or weeks. Now, when we talk about going short, we're talking about looking to make money when a stock goes down. And yes, that can happen, and yes, you can do it. A lot of people think short selling is reserved for like hedge funds or big banks, etc. No, any retail trader can short stocks. So let's jump back to the beginning. And when we talk about going long, and again, that's same thing with going short. A lot of times when newer traders hear going long, they think means you're buying the stock and holding for long term. Now that would be more what we would call investing. So it's easy to confuse. So if you're like long, short, why don't I get this? It's not the best terminology. You go back in like history and it's like, I think they could have chose different terms for this, but they're the terms we deal with. So that being said, when we say go long, we're looking to buy a position in that stock with then the anticipation to sell higher for profits or sell lower for our stop loss, take that loss and move on. Now, remember, with any trading strategy, it's what trips up a lot of people. You got to understand that losing is part of trading. Losing is part of trading, losing is part of trading, okay? I say that 3 times because so many traders let their ego get involved and they want to win and they don't want to be wrong. Like, that's that ego talk, and nobody likes being wrong, okay? Your wife, proves you screwed something up, or your husband or your boss. I mean, it doesn't, you make a mistake and your boss points it out to you in front of the entire staff. It doesn't feel good. Nobody likes that, even though you knew you made the mistake. So understand losing is part of trading. That's why we always have a stop loss. But in this scenario, let's say we're looking to buy a breakout. So this is a stock that's gapping up big on news, has unusual volume, ideally in a hot sector. Maybe it's like artificial intelligence. Right now, as I record in the summer of 2023, hottest hot sector I have seen maybe ever. I mean, if this hot sector keeps going a few more months, maybe the hottest hot sector I've seen in 17 years. But we want that big, that catalyst, that price action, that volume, and the chart pattern. So let's say hypothetically we're buying this stock that's uptrending from, say, 60, 70 cents into the high 90s, and we're gonna buy that breakout at $1, and then we're gonna risk 90 cents, okay? So say we got 1,000 shares, risking 10 cents a share. So nice, good risk, small risk, you lose, $100, not bad, not gonna torch you. And then our goal is, say, $1.30. So when we go long, we buy on that $1 break. We immediately set our stop loss because you're a responsible trader with risk management, right? In that 90 cent area or maybe that 89 cent area. Then if that stock continues to trend up, awesome. We're looking for a 3-to-1 risk to reward ratio. We're looking to sell at about $1.30 because, again, as day traders, we're just looking to capture small pockets of opportunity several times a day, every single day, to get that daily paycheck from the market. So let's say that stock works, spikes up into the $1.30s, we take our gain and we move on. So that is a long trade. We bought low, we sold higher. Now, vice versa, maybe some news hits, maybe the market shifts, and we buy that stock at $1, fades back down to 90 cents, we stop out, we take that small but acceptable loss. So those are the 3 variables of a long trade: our buy, our goal, and our stop. And again, we made $300 on that 30-cent move. We would have lost $100 on that downside move if the trade didn't work. Now, let's go on to short selling, okay? Lot more details and intricacies on short selling. So I'm gonna start out with the price action and how we enter and exit these trades. Then we'll move on to some of the things that a lot of people frequently overlook. So think about the same trade, okay? Let's use the exact same stock, exact same example. So that stock is now bumped up from 50, 60, 70 cents all the way up to $1.30, okay? The long guy, the guy that traded it on the uptrend, He's sold, he's moved on, he's taking his nice gain. Now, you're a trader that's short bias or just looking to trade price action. We love volatility. As an experienced day trader, you'll learn you don't really care if the volatility is up or down. We can trade with no directional bias. So let's say that stock's really struggling with a $1.30. And it kind of starts fading back, and can't reclaim that $1.30 level. So let's say now you're going to short 1,000 shares with that same risk management profile of 3-to-1. So let's say, just to keep the numbers easy for me, normally you'd probably short like when the trend breaks in the low 120s, but let's say you shorted a $1.30. Just keep the math the same for me. And you're risking 10 cents of upside. So if that stock trends back up, reclaims the trend, you recognize the price action, you're like, whoa, this is no longer a short. So that 10-cent upside move would cost you that $100, that $100 loss. Vice versa, you think that if I short this stock because it can't continue to break out, really struggling, volume is fading, maybe the overall market is shifted, the indexes are selling off into the end of the day. So you like this risk management, and then you're looking to cover back down at $1. Same risk management profile, up, down. 10 cents of risk for 30 cents of reward. So that stock does fade, cracks, sells off into the end of the day. Remember, this stock in this scenario started out at like 50, 60 cents on the day. So there's plenty of downside. Stock washes out as we sell. You cover, you buy to cover at $1, and you just made your $300 while risking $100 to the upside, okay? Now, few terms. When we're going long, we talk about, buying and selling. That's basically all you do. You're either buying or selling. Now, remember, with short selling, you're doing it in reverse. Now, this is where I want you to take out the notepad, all right? So you're actually, this is where it gets confusing. You're selling before you buy. You actually take a negative position. Now, I know that's confusing, but you're like, this is right, okay? First time you hear it, it'll go over your head. You actually borrow shares from your broker, okay? You borrow them, you pay a small fee to do that, fees and interest, but then that allows you to take a negative position of that stock. So going back to our scenario, when you shorted at $1.30, if you looked at your brokerage account, you would actually have negative 1,000 shares in your account. Negative 1,000 shares at $1.30. Now that stock collapses, and we now buy to cover. So we're buying 1,000 shares to take us back to neutral. Where before, we're buying 1,000 shares, we have a positive position, and then we sell those shares to go neutral. We're now reversing that. Negative position, buy back the shares, go neutral to 0 shares, and collect the premium. $1.30 to $1, $300 in your account. So again, maybe watch the video twice. Once you understand it's just reversed, you're still buying, keep in mind with short selling, people kind of overlook this. You're still buying low and selling high, ultimately. It's just you're reversing them. Now you're selling and then buying. So you, just like the guy that went long, maybe the same guy. I mean, if you're an agile trader, you might have went long in the morning, you might have bought it $1, sold it $1.30, and then in the afternoon, sold it $1.30 and bought it $1 and collected the same premium both up and down. So short selling is amazing if you understand these rules and you understand the risk, okay? One thing with going long, stocks can only go to 0. When you short a stock, remember, the higher it goes, the more money you lose. And it can get bad very fast. So hence the reason I recommend people get consistently profitable, learn how to trade going long, then start short selling and experimenting, whether on paper or very small shares, until you get the mechanics down. Because when these stocks move fast, you got to know, okay, I need to buy to exit this position. I need to, I need to do all these things. I've had it happen, actually, is one of the bigger losses of my career, where I was trying to cover a stock. I was trying to buy shares, and I actually hit the wrong side of my order box and actually sold more short. So this stock's rocketing up, and I doubled my short position on accident, which means it doubled my losses in seconds. So that's why I want you to start out very small, start out paper trading on the short side, trade 10 shares, trade 1 share until you understand the mechanics. So that being said, my friend, if you like this video and you really want to get more in depth, what we're doing every single day at Stocks Trades, we do what's called the Daily Income Trader webinars. We're doing these webinars 6 times a day, starting out at 8 a.m. Eastern, all the way up to 9 p.m. Eastern, and they're 100% live. Through the trading day, 100% free as well. So it's really a great way to get live commentary, live trading, and really get a detailed tour of the Stocks to Trade platform. Click that link below and would love to see you there.